Welcome back to this course. In this section, we are going to discuss 3 core areas of trading that form a complete trading plan. This section is going to build a foundation for our discussion in the course of this entire academy. So let's dive straight into it. Consistent and profitable trading requires a combination of trading strategy, risk management, and psychology. Having a great strategy alone will not make you a consistent and profitable trader. Trading strategy is the process. It is a fixed plan that is designed to achieve a profitable return. Putting together a trading strategy involves developing a set of rules on how you are going to identify trade ideas, setups, entry, management, and how you are going to exit your trades. Spend time backtesting the strategy I'm going to teach you in this course. And that is a best practice that you need to develop, because any strategy you learn, you must backtest and develop your set of rules that you can apply in the market and get consistent results. That way you can execute without involving your emotions. Now, talking about emotions, this brings us to trading psychology. It doesn't matter how good your strategy is or how well you manage risk. If you don't develop a right trading psychology, then you are likely to fail. And the reason why most beginner traders don't succeed is not because they don't have the right strategy, but it is because of psychology. Although risk management forms a big part of many traders' failures as well. So what is trading psychology? Trading psychology is the mindset in regards to loss or gain of money in a trade. In the course of your trading, you are going to lose money, and you're also going to make money. So what emotions would you experience when you lose money? Would you get angry? Would you be depressed or unhappy? How about when you make money? Would you be excited? Would you feel like the king of the market? Now remember, both negative and positive emotions are not good for your trading. You're supposed to remain emotion neutral and remain focused. Now this is not easy, but with practice, you'll be able to develop a bulletproof mindset. Let me share with you a few rules that will help you build the right trading mindset. Understand that losses are normal and are part of the process. Personally, I look at losing a trade as the cost of doing business. That is the cost of trading. I learn more from the trades that I've lost than the ones that I've won. So whenever I lose a trade, I go back to the trade and learn from it. The problem is, if you don't learn from the losses, then you lose those opportunities. Secondly, develop a long-term perspective as opposed to short-term. Looking at trading in the short term is risky because some people tend to risk too much in single trades and end up losing a lot of money because they don't manage their risk properly. So if you look at trading as long-term, then you'd get a little bit out of the market, and in the long term, you're going to be profitable. The third rule is to develop mechanical trading with no emotions. You can do this by having a process in place with set rules that you follow in every trade entry, management, and trade exit. Continuously and consistently invest time in backtesting the strategy. Now, through your backtesting, you'll be able to validate your strategy, process, and set of rules, which is very important for your psychology. Understand that every trade is a probability, and that is the reason why we look for high probability setups. Now, if trading is a probability, it means that whenever you have a trade setup, it may either get into profit or it may get into a loss. That is normal. Our system already gives us an edge, and I'm going to demonstrate to you how risk management is going to help you become profitable in the long term. Avoid revenge trading. Revenge trading is where you lose a trade, and either in the next trade you put a big position size so that you can recover from that loss, or you place another trade which does not meet your criteria. Now this is dangerous because in most cases you'd lose the trades that you place with emotions. Always use stop loss. Failure to use a stop loss is going to impact on your psychology because, for example, if you place a trade and you fail to put a stop loss and the trade goes in the losing direction, stop loss will help you get out of the market before you lose a lot of money. But if you don't do that, then your losses are going to increase and you'll be hoping that price comes back so that you can mitigate the losses. And worst case scenario is price doesn't come back. This may lead to you drawing down your account. However, even if the price comes back, you're going to be impacted emotionally in the process, and you don't want this to happen. So always use stop losses and never forget to do that. Take a break from the market after every losing trade as well as winning trade. So my rule is that whenever I lose 2% of my account, I always take a break. Similarly, after every winning trade, I take a break from the market That helps me with managing my emotions because there's likelihood that I would be impacted negatively from a loss of trade. And at the same time, when I win, I'm likely to be excited. So when I take a break from the market, it helps me get to my neutral state so that when I come back to trade, I come back when I'm very stable emotionally. So I'd advise that you also do that. So I've introduced you to what trading strategy and psychology is. Let's now look at risk management. When it comes to risk management, it's a combination of how much money you risk per trade and what is going to be your reward to risk ratio, and finally your hit rate. How much you risk per trade is going to determine your lot size. We'll get into the details of calculating the lot size later on. Risk to reward ratio is how much you gain for every dollar that you risk in each trade. Hit rate is the percentage of the number of trades you win over the total trades that you place over a period of time. Let me explain these three areas of risk management and how this is going to make you consistent and profitable in the long term, only if you adhere to the rules. So I'm going to use an illustration to do this. Assuming your account balance is $1,000 and your rule is to risk 1% per trade. By the way, never risk more than 2% of your account in a single trade. Anywhere between 1 to 2% is okay. Below 1 is too little and might take you more time to grow your account. And above 2% is too risky. You may draw down your account within a very short period of time. So let's say your risk per trade is 1%. Reward to risk is 3 to 1. And your hit rate is 50%. Meaning that for every trade you place, you risk $10 to make $30. In other words, if the trade runs into a loss, you lose $10. And if you win, you make $30. And for a hit rate of 50%, let's say that over a period of 1 month, you place 10 trades. So 50% means that you're going to lose 5 trades. That is $50. And you're going to win another 5 trades, which is $150. Therefore, your net profit is $100, which is 10% of your account. Now, 10% means that you're doing very well. Meaning that if you consistently maintain 1% risk on your account and take trades with minimum of 3 to 1 risk to reward ratios, even if your hit rate is only 50%, you'll still be profitable. Now, that is the power of risk management. It calls for a high degree of discipline to stick to these rules without deviating. In summary, consistent and profitable trading requires a combination of strategy, risk management, and trading psychology. You must backtest and develop your set of rules that you can apply repeatedly. That way, you can now execute without involving emotions. When it comes to risk management, it's a combination of how much money you risk per trade, what is going to be your reward to risk ratio, and finally, what is your hit rate. Ensure you include strategy, risk management, and trading psychology in your trading plan. See you in the next lesson.